Well, hello everybody, and welcome to RealWealth's weekly webinar. My name is Ben Eric Smith. I'm the Investor Relations Director and Investment Counselor. Today, we're talking to Joe McBreen, and we're all going to talk about the lending industry, what's happening on the ground due to this whole COVID thing, and just overall, interest rates, historic lows, has the volume gone up, gone down, where he sees it going, what works, what doesn't work, Fannie, Freddie, all that stuff that I know everyone's dying to do. I got a friend who's buying a house in Tampa, and I couldn't believe how low the rates were. I was like, really? 3.5, whatever. It was just ridiculous. But anyway, so today's May 13th, 2020, and we're happy you are here. We'll go through some of the house cleaning stuff at the beginning, and just sometimes I forget to point this out, but we expect to have a lot of questions. So if you have anything, you're watching this live, go ahead and type in any questions you have in the GoToWebinar control panel there. You might have to maximize it by hitting the little orange arrow button. And we will get to those questions either during, as we go through, or definitely at the end, as many as we can fit in. All right, if you could, Joe, advance one slide for me, please. All right, so tomorrow, exactly 24 hours from now, Kathy Fettke will be here talking to our Tampa team, either Colin or Dave, about what's going on in their market, some really exciting changes with them. I mean, nothing major. They're going to continue doing what they're doing, but they've got some additional stuff they're going to be talking about. So we'll be talking with them, and that is tomorrow. Advance one more slide for me. Okay, so our little disclaimer here, obviously today's a little different because it's an educational webinar talking to a lender, but I'm just going to read it anyway. Strategies mentioned today may not be appropriate for everyone. Other options not mentioned may be more suitable for your situation. Consult your CPA, tax advisor, attorney, Aunt Mary, anybody you want to discuss your specific situation. Past performance never guarantee future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and or updates always exists. Not too worried about it with Joe. We've had Joe and Maggie out at our event. When was it? Last September, October, something like that?
September, October, yeah.
Mm-hmm. Yeah. And I mean, the response was great. You guys did a great job up there on the stage, kind of talking about everything. So we're going to do that same thing today. Go ahead and get past the legalese for me, Joe. We'll talk a little bit about you. So 30 years combined between Joe and Maggie on the right. They're so busy, Maggie couldn't join us today, but that's okay. Joe will do an admirable job. But Joe ranks in the top 200 loan officers nationwide, is a national real estate speaker, focuses on first-time homebuyers and real estate investors. Obviously, today's talk is going to be mainly focusing on the investor side of things. Maggie focuses on conventional jumbo FHA, VA, and condo financing with expertise in investment property financing. So you guys both do a lot of investment stuff. Like what percentage out of like every 100 loans, how many of them are non-owner occ loans, roughly, if you were to guess?
I would say that unit-wise, if we, typically we'll close between 60 and 70 units a month. Right now, I would say that of that percentage, 45 to 50 of those units would be investor concentration loans or investment property deals.
Okay.
We tend to do a lot of multi-unit deals for single borrowers too, so it kind of adds up when you're doing 4 or 5 or 6 loans at a time for one individual borrower. So that would be an average for us over the last 3 or 4 years.
Okay. All right, well, take it away, Joe. Let's see where this takes us.
Well, yes, thanks for having me. Please excuse Maggie's absence. We are pretty busy at the moment, and she is taking some calls while I'm addressing all of you and answering any questions we might be able, and any insight we might be able to provide for you. My name is Joe McBreen, originally from Ireland. I've been in the mortgage business now myself almost 19 years. Maggie has been there, probably doing it with me for about 16 years. So overall, more than 30 years combined in the industry. We are a full service lender, kind of like the slide says. We do all kinds of residential lending, jumbo, condo, govie. But we do focus, in the last 7 or 8 years, we've begun to focus on the investment property niche within the industry. And, I would say we're among a few others that are national leaders in this space in terms of the production that we do. So there's not much we haven't seen as it relates to, borrower individual guidelines or characteristics, Fannie Freddie guidelines, or just changes that we see within the market as it relates to the bond market, stock market, and geopolitical factors that could influence our markets. But we definitely appreciate being on the call with you guys, and I'm happy to answer any questions you guys might have throughout the hour.
Cool. So yeah, no questions yet. I mean, we have a couple, but just go ahead and just advance and just kind of give us an overall picture of where things are right now, why you think they are where they are, and then we'll just take it from there.
So this next slide, a slide I chose just to show it's a 52-week range on primary home mortgage rates to show where we currently stand as it relates to your primary home rate. Now, Ben, you mentioned that your friend's getting a great deal, purchasing a new property, and typically in the low threes, that would be for a primary home or a second home residence. So we're seeing, across the board as a result of economic factors related to COVID, that we have, seen these historic lows in rates. And these are rates that we really haven't seen since coming out of the Great Recession. Now, as it relates to investment properties, we are seeing also historic lows in terms of rates there. Now, I wouldn't say you're going to get 3.2% on a investment property with 20 or 25% down, but certainly you would get into the low fours or high threes based on your individual characteristics, of course, credit scores, down payment, property type, and things of that nature. So still historic lows as it relates to investment properties, but there's always going to be that little bit of a premium to rate because of the fact that it's an investment property and not, your primary residence.
Have jumbos or did they go away for a little while and now they've come back, or?
Right. Well, what we've seen as a result, jumbos we had a very healthy jumbo market prior to, COVID kind of like taking over, and becoming such a pandemic and such an issue. But once that became a reality within our industry, we did certainly see some retraction from jumbo lenders. Most jumbo lenders are portfolio lenders, which means that they put those jumbo loans on their books. They lend out their money to those borrowers for those loan sizes, which is a little different than Fannie Mae and Freddie Mac, who are the investors for, the conventional financing that we see. And each market may have a conventional loan limit. But the jumbo market definitely had some retraction. As it relates to, credit scores, down payment requirements, whether it's a cash out refinance or just a regular rate and term, no cash out refi, certain restrictions or retractions applied, just because a lot of these jumbo lenders are also the big servicers of loans. They're also the ones that service a lot of these loans. Certainly the loans that are in their portfolio, they have to make sure that the taxes are paid, the insurance is paid. And even on the conventional side, if it's Fannie and Freddie that need to be paid for principal and interest, those guys really needed to retain their capital to maintain as much servicing as they could, in lieu of, some folks maybe entering into forbearance, because of COVID. So we saw kind of a natural retraction there because generally speaking, they were just retaining the capital so that they could service as much of their portfolio as they could. And that, I think, is a short-term retraction. I think certainly you're seeing some jumbo lenders come back to the market a little bit more now, albeit with maybe tighter loan guidelines or loan to value guidelines. But we expect that to free up again as, we develop out of shelter in place and we hopefully get COVID numbers to start going south rather than north. And then obviously if a vaccine becomes available, we would hope that the full-blown market comes back to the level it was at prior to, the COVID situation that we're all experiencing. So as it relates to, I just mentioned forbearance, obviously the CARES Act allowed for some folks who run into a hardship or who become furloughed from their work or unemployed to basically, push their payments down the road a little bit if they cannot afford to make the payments while we're experiencing this economic downtrend. Now I will say forbearance is not forgiveness, as we know. It's really just pushing, as I like to say, kicking the can down the beach. You really are responsible still for making those payments one way or the other. So what we're seeing is folks maybe applying for the short-term relief, and then most servicers would look for that recoupment of those payments on month number 4, or you could enter into a repayment plan, if you like. Another alternative would be to just add those missed payments onto the loan balance of your mortgage. To qualify really for either of those, whether it's the repayment plan or adding it to your mortgage, typically the servicers are going to require that you do prove a hardship at some point, so that hardship being, the loss of job or a medical concern, not just simply, I wanted to, take some relief while I was, temporarily unemployed. You really need to have that hardship ongoing for forbearance to be continued past that 90-day mark. So we do try to advise all of our clients on each servicer of their loan. May have different forbearance qualifications, but generally speaking, there's no barrier to entry for forbearance. You just want to make sure that you're familiar with what the qualifier is for continued forbearance, for 6, 12, or adding to your outstanding loan balance. Because typically with the forbearance options, the loan is technically in default, right? So it's just forgiven. It's not a hit to your credit score, unless, of course, you don't prove that hardship after the 90 days. So it can become a problem down the road, I think, for folks. So it's wise to, I think, at least if you are taking advantage of the forbearance options provided and allowed for, that you just understand where you might be in 90 days time or 120 days time, and can you continue with forbearance, depending on your current situation. So it's a great option for folks that are temporarily, feeling some pain.
Yeah, I mean, it's the two questions that I would ask are, number one, is it something that you're going to add it to the end of the loan 30 years down the road? Or some banks are like, yeah, we'll give it to you for 6 months, but the balance is due at the end of 6 months. So it's like, well, what good is that? It's if I can't pay $1,000 a month now, I'm not going to certainly be able to pay $6,000 in lump sum 6 months from now. Yeah. So that's the first crucial question. And then I think you mentioned the second crucial question is, okay, they might give it to you now, but then in 90 days, you're going to have to prove that it's a hardship. So if you're kind of like, hey, let's take advantage of this, and then you can't prove anything in 90 days, then you might suddenly find yourself up the creek without a paddle, which isn't necessarily a good thing, right?
Well, there's just bigger negative credit connotations there, if that were the case. So we certainly try and advise folks and consult with folks on, if you can make the payment, regardless of the short-term moratorium on the tenant maybe not being evicted for not paying rent, because ultimately as a lender, we're qualifying you for that investment property with 6 months reserves on that investment property, primarily in lieu of that tenant maybe being vacant, or the property being vacant because the tenant moved and there was a short-term loss of rent there. So up front, if you can make the payment, I would advise kind of staying current with the payments and not again, like just kicking it down the beach because you can. But certainly if you have to avail of it, and you do have a hardship, then I think most servicers are, going to have a policy in place where you can add it to your outstanding loan balance or get into a repayment plan, like I said, for 6 or 12 months. So that as you maybe come out of unemployment or out of furlough and back to work, while you may not be able to afford that large 3 or 4 month payment, because you had the hardship or you have an ongoing hardship, you should be able to qualify. But I would say most servicers are a little bit different in terms of their guidelines and their policies. So you really need to check with the servicer and ask the proper questions. Yep. And dig a little deeper with them, outside of just like, oh, I'm just going to take it for 90 days and see what happens, because it could have some really negative credit connotations, and you could end up like really like in default and getting your credit dinged for loss of payments.
Yeah.
And moreover, it's like a case of if you are in forbearance, we don't know for sure yet what the final guidelines are from the FHFA as it relates to had you taken forbearance, at what point can you then finance another property, or what point can you refinance any residential mortgage? Some are saying that because the loan was in forbearance, then you may need to wait 12 months or have 12 months of continual payments before you can finance something again. So if it's a case of, I want to, finance something down the road in 6 or 9 months, but you took forbearance, you may not be able to do so without having to show that you've had 12 months of continual payments again. So there's a lot of unknowns out there as it relates to it. Nothing really defined. I know that there's been some conversation about, if a client were in forbearance, why shouldn't he, and he's back to work and the rates are still good, why shouldn't he be allowed to refinance to pay back the 3 months that he missed? So there's definitely that conversation being had. And I think that, the head of the FHFA is considering that at the moment, as opposed to a hard line in the sand of having those 12 months of payments, consistently after you come out of forbearance. So it's ongoing, it's developing. I think it's something that you should avail of if you have to, but if you don't, then I wouldn't.
Right. That makes sense. All right. So moving on here, we got a few questions, but I'm just going to save them for the end. So just continue, Joe.
So this slide is just kind of, I just got ahead of myself. It's like a little bit of more about the forbearance and the concerns. This one, we get into a little bit more about the liquidity and why the servicers are squeezed a little bit, because all of the lenders, all of those servicers of your loans have to make the payments, even if you're in forbearance. And there's a certain, as it relates to the current environment, I think there's upwards of, 4 million borrowers in forbearance at the moment. And that really equates to about carrying those payments for the servicers as an industry equates to about a $5 billion a month tab. When you relate to principal and interest and taxes and insurance. So at some point, the government has stepped in and said, okay, there's a cap on that. If after 3 or 4 months of forbearance, the servicer has fronted those payments, and the borrower does go into default, then Fannie and Freddie will come back in and then repay that servicer. But in the short term, it's a big squeeze, it's a big crunch on those servicers. So that's another reason why you've seen a lot of retraction in the industry as it relates to certain loan products, the jumbo, the portfolio loans, and certain product like that being suspended or certainly tightened up a lot.
Yeah, for sure.